Hello, everyone. Monty here, market analyst at IGUAE. Whew, it's a busy Monday. And that's because we had plenty over the weekend. Lots to digest. I want to go ahead and pull up IG's trading platform. We're going to take a look at US Tech 100, which you take a look at it and you go, it's not looking too bad. Okay, it is down a little bit this morning, futures, as of publishing this video. But overall, for the week, it was up. It outperformed. But let's face it, that's because it's got, as mentioned last week, smaller financial weighting, first of all. And second of all, those bond yields coming back down, expectations of rate hikes no longer being priced in. That's definite plus when it comes to tech and growth stocks in particular. I want to go ahead and pull up exactly what's been happening as of late because we've got quite a bit to process there. So obviously the big one's going to have to be the acquisition, a UBS acquisition of Credit Suisse. Okay, the price, I know shareholders not happy about the way it went. Well, they didn't have a say in the matter, both sides, both for UBS and Credit Suisse. You got that 100 billion franc liquidity line from the Swiss National Bank, government guarantee of 9 billion beyond a certain loss, certain threshold on losses on key assets. But here's been the big problem. AT1 losses, that's been a sour part. We're talking about 17 billion. And those that have exposure to it, not just the AT1 additional tier 1 bonds when it comes to Credit Suisse, but in general, there's going to have to be a repricing when it comes to the market. Because let's face it, we've had Silicon Valley, Signature, Silvergate. You had the fears when it comes to regional banking, which we'll get to. And then now you got Credit Suisse. When it comes to depositors, no one's worried on when it comes to depositors, and that's not a bad thing, by the way. But then when it comes to being a shareholder, or when it comes to being a bondholder, well, then you got to really start to worry, and especially so, if you don't have much control or as much control as you thought. And when it comes to bonds, by the way, we already saw when it came to investors, they were getting out of high yield. We had the Refinitiv Slipper report when it comes to week-on-week investor flows. They were getting out of high yield bonds, going into government bonds, and especially when it comes to cash and primarily money markets. So really locking in the short term, the average duration for a money market, 2 to 3 months, locking in over the next 2 to 3 months. We saw a lot of that late last year, but we're especially seeing it right now where a lot of them are saying, okay, you know what, we don't want to have exposure. We don't want to keep a lot of larger funds in the big banks. And second of all, for the time being, let's go ahead and lock them in. And that's essentially what we've been seeing. So I want to say that for now, this is a negative event, you could say, for shareholders, a negative event basically for owning a bank or being related and owning their assets when it comes to, say, biggest examples when it comes to AT1 bonds. But long story short, being those two in the current environment, not the best situation, though valuations have come down, and that's essentially why we've been hearing talk of potentially Warren Buffett and others potentially entering in and buying up when it comes to, say, regional banks in the U.S. But the other thing that happened also is that we had an announcement when it comes to global central bank coordination. It was the Fed, you had the BOE, the Bank of England, you had the European Central Bank, you had the Bank of Canada, Swiss National Bank, as well as the Bank of Japan. Now, there's a facility that was already in place when it comes to dollar swaps. It was weekly, 7-day dollar swaps. And now all of a sudden they said that it's going to be daily. It's going to be on offer starting from today up until at least until the end of April. So the thing is that if that's going to help alleviate some of those dollar shortages in some of the banks, that means for the Fed, it's no longer about trying to take care of banks, on the mainland, if you will, within the U.S. It's now a matter of thinking, okay, you know what, whatever happens with what could have happened with Credit Suisse and others, this could come back and haunt our financial system as well, and has global implications. So this is really about helping a lot of those banks globally, or especially in those 6 key regions mentioned. But at the same time, if you want to look at how much of it has been used so far, it's under $500 billion. We're usually used to seeing $4 to $5 trillion if you look at the start of the pandemic as well as the global financial crisis. So far, this is more about them prepping in terms of what to expect. And finally, I want to point out that over the weekend, First Republic Bank, got $30 billion infusion last week from a bunch of major U.S. banks, but it got downgraded despite that, got downgraded by S&P Global few notches, and it warned of another downgrade. So that means that regional banks, I want to say, not out of the woods just yet. So that's when it comes to what's been happening overall. What about when it comes to the week ahead? We got ourselves 3 central banks. We're going to pull up the report in just a moment, the link of which, by the way, is available in the description of this video. But when it comes to market pricing of these hikes, now, heavy majority now, and these market prices continue to change, especially with what's been happening. So don't expect this to stick. It might even change by the time the video is released, but it's heavy majority now that there won't be a Fed rate hike, and that market pricing is changing quite quickly. It's slight majority that on Thursday, there's not going to be a increase in the Bank of England from the current key rate of 4%, and it's still fully priced in on 25 basis point increase when it comes to Swiss National Bank, but a small minority venturing into 50 BP territory. Let's go and pull up the report. As I mentioned, this is available in the description If you want to subscribe, do reach out to us and let us know. But those are the key items. Fed policy is going to be on Wednesday. BOE and SMB are going to be on Thursday. You do have some pricing data for the UK on Wednesday, as well as Canadian pricing data on Tuesday. And for Japan, that's going to be on Friday. Though, let's face it, given that the Japanese government, the 10-year yields are no longer anywhere near the upper 50 basis point cap. This drop in yields globally has been a positive when it comes to the Bank of Japan. It really means less pressure when it comes to them wanting to tweak their current yield curve control program. And I think that for the current phase at least, bond values being higher is going to be a positive for banks, given that means that their unrealized losses are going to be less. Also, when it comes to institutional sentiment, I want to point out that's up here, these circles. We have retail sentiment and institutional sentiment. This is a weekly market report, so it's week-on-week changes in retail sentiment. For COT speculators, that's institutional sentiment right here. The COT, there was a delay for quite some time, and now they're sort of catching up with the releases. So the outer circle is not positions as of last week, but March 7, the inner circles of the week before. But most likely they're going to have another update this week before the usual update on Friday. So if that happens, that will be reflected in the daily market report. And I want to point out that although you're looking at some of these going, okay, the technical overview might be consolidatory, for example, doesn't mean that we won't be seeing some significant moves, especially when it comes, because we're seeing some fundamental shifts. Especially when it comes to something like GBP USD, because you've got both the Fed on Wednesday as well as the Bank of England on Thursday and CPI tomorrow as well. So that's something to keep in mind, that just because the technicals have been consolidatory, relatively range bound, levels relatively holding, doesn't mean that's going to be the case this week. Not just processing what's been happening on the global risk appetite front, but also when it comes to central bank announcements, because let's face it, when it comes to the Fed, which is going to be the big one this Wednesday, it's going to impact anything priced in or against the US dollar. So all the FX pairs, the commodities, well, gold and oil, and when it comes to risk appetite globally as well. So with that in mind, I want to thank you guys so much for watching, and happy ticks.